I've been managing fixed income portfolios for a little over 2 decades now, and 2023 is shaping up to be one of the better opportunities that I've seen in the fixed income space for a long, long time. You have to go back to pre-2008, pre the GFC, to see the kind of yields that we're seeing today. So the starting yield is a very important characteristic for any fixed income portfolio, and it's a very good estimate of your forward potential returns. So everybody knows where treasuries are today. They're a lot higher. We can build yield on top of that through the portfolios that we manage. So we're seeing our, depending on the type of portfolio you're looking for, north of 5% on a portfolio that is average investment grade quality. At a broad level, when we look at the fixed income markets, we're seeing value in yields themselves. So when I look at the treasury market, with the Fed nearly done its interest rate hiking cycle and inflation peaking and rolling over here, that's a good setup to move out the curve. So we actually are extending out our duration and bringing it closer to some of the traditional benchmarks that are out there. So that's number one. And number two, when we look at the spread sectors, there's a lot of great opportunities there from a top-down perspective, mainly in the North American market, where we see actually very good fundamentals, even given the prospects of a mild downturn coming. You're getting a nice premium to invest in things like BBB, BB, investment grade corporate, high yield corporates, as well as in the securitized space. So we have some access there. And then lastly, we're seeing potentially seeing some opportunities opening up outside of the United States and tilting potentially into the emerging market space and the foreign global space in the developed market area outside the United States.
A lot of people were saying that 2023 could be the year of the bond market. But in my opinion, this assertion, this assumption needs some clarifications. When we look at the volatility of the bond market and the expected volatility of the bond market for this year, specifically at the beginning of this year, the volatility is expected to stay very high, simply because we have central banks that they will continue to tighten their monetary policy. Why are they constrained to hike their rates in that situation? When we look at the mix, growth and inflation, this mix both sides of the Atlantic in Europe and in the United States is very strong. I mean, inflation is here to stay. The core inflation, when we exclude volatile components, will decline quite slightly and will stay above the target of the central banks. When we look at the growth, for example, growth is much more resilient than expected in Europe and in the US. And this resilience is explained by the strength of the labor market. So when we combine all these elements, the central banks, they are constrained to continue to hike their rates. So we do expect the ECB to reach its key rate to 4% for the first half of this year. So in that context, we have to wait the second part of the year to see opportunities on the bond market and specifically on the sovereign bond market. We have to wait some clarifications coming from central banks, Fed and ECB, and clarifications regarding the moment where they stop hiking their rates. At that moment, clearly, the long-term interest rate would start to decline, in line with the decline of the growth rate and the shallow recession that will occur and is expected by the year end.
After an annus horribilis in 2022, 2023 is expected to be an annus mirabilis in bonds market. 2 reasons. The first, recession was most likely avoided in Europe. The consensus is converging towards a very moderate growth scenario. So, the debate is fading with low volatility and lower risk premium. Second, in our view, the resilience of inflation should lead central banks to maintain a restrictive policy throughout the year, with, however, the near end of upward cycle. So, what are the opportunities for fixed income in 2023? 2023 is the year of bonds. Whether it's interest rates, credit or green bonds, we think there are a lot of opportunities. If I go into details, on sovereign bonds, record funding requirements in 2023 should push nominal yields higher. Yield curve should stay flat and spread should tighten. The carry is positive again on government bonds. In fixed income market, we see opportunities to add duration in portfolio after rate hikes. On credit, yields on both Euro investment grade and Euro high yield are at 10-year high at the beginning of 2023. Financials looks more attractive than corporates and subordinated debt and hybrid debt even more. Finally, go green. Sustainable bonds remain in high demand to finance the green transition. The market remains dynamic and risk premiums are cheap. The greenium or green premium is not an obstacle given the substantial rise in yields.